I would say if you have an opportunity to speak in front of people, if you have an opportunity to just tell people what you're looking for and what you're doing, just do it. And that's where you get the best deal, where it's mispriced and you get a lot of margin safety. Don't go to private equity. Go buy a business. Fuck private equity. Go buy a small business. It's always good to see you guys. Definitely, we're gonna have a really good series of speakers. I have like an attorney. I have an SBA person. I have a broker also. Just trying to confirm. And I have a really good friend of mine who used to do essentially deal flow for acquisitions. And he used to be the guy who actually goes and does the first meeting and nurses the deal through close. And he's a killer. So I want to bring him in. Great guy, super great guy. But you would love his approach to how to take that first meeting and close on, make sure that the deal closes. Um, Before we introduce here's John. Before we introduce Chandra, do you say Chandra or Chandra, or how do you say your name?
Chandra.
Chandra. All right, with the T. All right, Chandra. Okay. Hey Sham, what's up? Jonathan, what's up? All right, guys. So who has any updates? We'll go quick. Kurt, you got anything?
Yeah, real quick. Jay, I'm intrigued by your comment, your buddy who's owns Anytime Fitness franchises, because I've been extremely distracted right now because I've been looking at a franchise opportunity that's in the fitness world as well.
Yeah.
So I haven't been looking at existing businesses and kind of doing the traditional search, but I've kind of gotten pretty far down the road on looking at this opportunity. I'd love if this guy's if he's willing to connect, I'd love to connect with him and ask
Yeah.
him some questions.
If you
about
text me your info, text me just a reminder, and I'll
Yeah,
connect you guys.
that
Really
would be
good guy.
awesome.
Yeah,
Awesome.
yeah. Is it a brand new franchise?
It started in 2019.
Okay.
So it's new. The concept is old. The guy used to sell licenses before, and he sold those globally, some over 2,300 licenses, and he rolled out the franchise 2019. So it's a little new.
No, but this is a new location.
Oh, sorry. Yes, new location. Yeah.
Ah,
I'm not, yeah. Yeah.
okay.
My bad.
Very nice. All right, no worries. Adam, you got any update?
No, we're still trying to. We've been all consuming with this damn house in Florida.
Oh,
I
okay.
think we're gonna, yeah.
I got it. I know.
So,
We don't want to. We don't touch that wound. I know it's tough. How about you, Zach? What's going on with your search?
Hey Jay, hey guys. You know, found some good deals, connected with some good folks about them, ended up saying no to them, but I think the connections still stand, right? So some of this has to do with who I'm building relationships with. One is a local small business consultant. Actually, several people have referred me to him, and so he really helps companies in the $3 to $10 million EBITDA space. And so he's been so generous with his time and helpful. And then he connected me with a local Christian businessmen's networking group here in town. And I met up with the leader of that group this morning, had a great connection. We're going to stay in touch and get together. And so I feel like a lot of it is kind of putting out the feelers, connecting with the right people. And it was interesting talking to this local business networking group leader. And I was pretty upfront about where I'm at and what I'm looking for and everything. And he said that he's got a lot of folks in that 50 to 60-year-old range, small business ownership. And he was like, yeah, they talk a fair bit about selling and getting out because they've been in it for a while. So happy to connect you with them or come to the meetings and kind of find something that way. So a little bit of a non-broker approach. Haven't really gone down the road of talking to CPAs and attorneys as much. So I feel like this is me kind of trying to do that in a different way. So it was good. Just a lot of connections. Yeah.
I can tell you that it's so powerful. So there's not a day when I don't talk to somebody who randomly found a business directly from the seller and got the best deal, the craziest deal ever. And I mean, I just recently talked to someone in GoBundance who's buying septic tank companies. And the first one he bought was someone who came to fix a septic tank on his property. And he was talking to the person that was there, and it turns out that was kind of like the main guy, the main operator. But the business was owned by somebody who's going through a divorce and trauma and all that stuff. And then he just threw out there. He wasn't even looking for a business to buy. He just say, "Hey, what do you think you would be selling?" It's like, "Yeah, he'd be interested." So he had a conversation with him. The business does something like 400 in SDE. He got it for $100,000 cash.
Yeah.
So I'm telling you guys, like, you gotta keep talking to people. So if you have a network like that, what I would do, create a presentation. It's kind of like a la Walker Dybel style, about talking about this wealth transfer that's going to happen. Baby boomers have the opportunity to transfer their businesses to millennials, and how to go about doing that, and how to find this. I'm just telling you, do a presentation for like 30 minutes or 45 minutes, 30 minutes in front of those people. You will get people coming at you telling you, "Hey, I've been thinking about selling my business for the last 5 years and I don't know how to do it." And I can tell you, I did this. I was telling you, my friend did this event in the Big Island. I don't know if you were there when I was talking, but I have a good friend who has this. He does an event for all his investors every year. He does it on Oahu. This year he did it on the Big Island, and I was there, and he invited me to speak at the event. And I spoke on business acquisition. And I was talking from a buyer searcher perspective, and how is it a good thing if you're, I want to diversify from real estate. I had probably more people coming to me asking me about how do I sell my business than people coming to me asking me about how to buy a business.
Interesting.
And so I had a couple that came at me with 3 different businesses. The husband has a security company in Oahu, and he asked me, like, "Hey, I want to sell so I can go and buy more real estate." And then the wife was a doctor, and she had 2 practices, and one of those kind of like Botox kind of practices, and she had one on Oahu, and they had just moved to the Big Island, so she wants to sell the one on Oahu, and she had it for a long time. So I would say, if you have an opportunity to speak in front of people, if you have an opportunity to just tell people what you're looking for and what you're doing, just do it. And that's where you get the best deal. That's another thing. That's where you get the best deals, where it's mispriced, and you get a lot of margin safety, and you get actually the guy I was telling you earlier, where he bought the 400,000 with 100,000, he only gave 25 grand up front. So I'm just saying, go out there and speak. And another thing I can say, I know you saw your post on Twitter about wanting to go to private equity. Don't go to private equity. Go buy a business. Fuck private equity. Go buy a small business. And I can tell you, this conversation about acquisition, it's only in the first inning. And I'm hearing the same kind of like same trend as real estate the last 5 years, when Bigger Pockets and all these different people came out and talking. The more people talk, I used to kind of laugh when I hear Cody Sanchez, because like she doesn't know what the hell she's talking about, and she talks. But I actually now I like it, because she's more and more people are hearing her, and then they're curious, and then when I say something, it's like, yeah, I heard something and I'm curious. So actually, she's doing a public service to us, where she's putting the seed out there for people. So it makes it easier for seller to have that conversation, buyers to want a partner, but also raising money. It's a lot easier to raise capital for deals. So there are going to be more and more people curious about, hey, can I invest passively in small business acquisition, as opposed to being an LP on a multi, where the other returns are limited.
Yeah, it's interesting, Jay, and thanks for reading my Twitter feed. I guess that's I only post like twice a month, but
that's good.
So
we're watching.
It's interesting. Yeah. Actually, I reached out to someone. I've reached out a couple times to folks on Twitter that are doing some interesting things and have a background I want to learn more about. And I'm surprised at how I just DM folks and say, "Hey, would you mind getting on the phone, learn more about your background?" And one of the guys I connected with, his name is JD Foote, Foote, and he's in New Zealand. He's got a psychiatry practice, but what he does is, and he's worked in some small businesses, but he's an independent sponsor now of like 10 or 12. And so he funds searches and puts in 500, 600, 800,000, into these startups. And he's got 10 or 12 and definitely snowballing it and talking about family office stuff now. But it was interesting to learn about his journey and how he's done it. Totally debt free too. It's fascinating. But anyway, only reason I mention that is that Twitter is a great place to reach out to folks and learn more. And then the last thing I'll say, Jay, is to your point about connecting with people and networking. I actually found this local Denver business networking group because I was talking to someone who bought a company, had been operating it for about 1.5 years, 2 years, wanted to talk to someone who had the scars, and he shared with me his journey. And he said that one of the things, the way that he found his acquisition target was by just going to a local business networking group, and someone was selling their business. He said it was doing about $1.5 million in EBITDA, but it was on a downward trajectory because it actually had like 6 different owners who couldn't agree. And so all the friction was causing it to just decrease over time. So they went from like 3 million, and after a couple of years, we're at $1.5 million. And so he went in and bought it, and he turned it around. But he said that he got it for about a 2 multiple, completely off market. And he just came in and kind of solved all the issues because he bought them all out. And it was just such a relief for them. But anyway, it's a testament of finding a good deal by networking and solving people's problems.
They're just, I would say, the Elk Lodge and the Rotary Club and your like all these old school kind of like groups. Those are the best because maybe they don't have there might be on the second cycle of their life, but they're also still connected to other people that are still working and still own businesses. So I would, and they're all looking for people to come and speak to them. Like everybody is looking for content. So offer yourself as I got content, and then do it. You only need 20 minute presentation, and then open it up for Q&A. And I can tell you, I did like a 30-minute conversation. I had like a 60 slide presentation, and I went through it too fast. And I thought it's gonna take me a whole hour, but it took me like 30 minutes. And then I had 30 minutes, and it wasn't enough for Q&A. We had to shut it down. And then so we end up adding like another breakout session just for that. And then I had more questions than I could handle. And then we went to the pool, and then we had more questions. And I went to the party, had more questions. And then we were like literally at the club, and I had people come at me with more questions. So I'm just telling you, like, people are curious. Just be out there, speak to people. And and then people were relaxed, and then they start telling me about their deals that fell through. I met a guy who had like he has the biggest short-term rental company, one of the top 4 in the country. They did like $10 million in EBITDA, recurring. And he was talking to a private equity company and how they found out about he had like a lot of ad backs, and he had his son working there. And then he said he was kind of like, I can tell he was annoyed by how much probing and how much digging they did. And so like I hear from the seller perspective, and then at the end it fell through because of the cycle. And I said, well, now it's a good time to prep yourself. You know what I mean? Just clean up, get rid of that. Take your son out of there if he's not working. Take your cars out of there if they're not for work. You know what I mean? Clean up your financials. Say it again, someone. Yeah. So
no, that's just clearing my throat. Sorry.
Yeah. So that's what I was gonna say is that the more you go out there, the more people. And then I'm still getting texts from people want to introduce me to other people. So I'll just be out there and just talk to people, and you'll find great deals directly, not not necessarily indirectly. So I want to get back to introduce Chandra, and then I want to hear your story. So why don't you go ahead and tell us a little bit about yourself and tell us about your business buying journey.
Sure. It's like a slow-moving train wreck. I'm kidding. So my background historically has been in technology. I worked for some of the big folks like Oracle, and then jumped to a really small SaaS company that just blew up and went bananas. So was very fortunate to participate in the IPO, and then took some of those funds and started buying businesses with a friend. So my first acquisition was in 2018, and that was an electrical contractor, all seller financed. Didn't really have a ton of infrastructure in place, but it kind of got the ball moving as far as the acquisition idea goes. Then in 2020, we purchased another electrical contractor, so we could kind of bring those two together and hopefully unlock some value, which I think we did a good job. And then in 2020, we also did the acquisition of an underground construction company. What we do with that is we basically build out the network for rural internet service providers. So for smaller tier 2 cities, things like that haven't had the investment up until the infrastructure bill that was passed last year, having gig speed was something that was kind of out of the question. But now these local ISPs are making that investment because they have free government dollars to do so. And we're participating and helping them build that infrastructure. And in conjunction with that, we purchased a fiber optic splicing company. So once the fiber is underground, you have to have a very specialized technician come in and splice those cables together, test it, make sure light goes through, data can pass, etc. So that's been the journey on the construction side. And then last year we purchased our first manufacturing company, which has been that was a joke I made around a slow-moving train wreck, but that's been the biggest challenge to date. Trying to figure out how to get this thing to be, self-sustaining and, dare I say it, potentially profitable in the future.
Nice. So let's go back to that first transaction. So tell us a little bit about how much did you buy that first company? What was the reason for the seller to sell? What was the deal structure and all that?
Yeah. So we bought the first company for $500,000. It was, EBITDA on that was supposed to be about $500,000. Our first year, we ended up doing a negative 90K. So there was a lot that I think in the handover process, what I learned from construction is that work in process isn't necessarily linear. So there's a lot of pad built in up front, and that's kind of what we experienced. But year two, we're kind of off to the races, and we ended up turning a profit. The reason for the seller to sell, I think he was very stressed out from managing people. Recruiting in this space is a challenge. And I think that he was kind of the old school operator mentality where, I'm not going to hire this out. I'm going to do it myself. And what I earn is going to be dependent on how much I do by myself. I'm not of that mentality. I don't want to do very much because I feel like there's a lot better and smarter people than me to get it done. So that's why he was trying to kind of sell the business. He wanted to stay on as the sales function, which he did. He ended up becoming a partner of ours for the second acquisition so that we could maintain a master license. And then we just completed his buyout in 22.
Completed his buyout. So you had like a 3-year earnout with him?
No. So we brought him into the next acquisition.
Uh-huh.
We needed to lock up his master electrician license. So we thought, all right, we'll give you some equity. You don't have to have the same headaches that you were having before. I think old habits are hard to break. So that's why we decided, hey, let's kind of go our separate ways. We'll buy you out.
So tell us, unpack that work in progress piece that you mentioned earlier. Like, what happened? How did it show up at 500 EBITDA at first, and then turn out into be a minus 90?
Yeah. So in electrical contracting, I think it's in most construction businesses, and this is something that I didn't have any gauge of. You can build your profit in to a bid in different phases of a project. So majority of profit for an electrical contractor is going to be in that rough in stage. So like that, the first phase of a project, which is typically call it 60% of the build. Now, 60% of the build could account for 75% of the profit on a project. So that's why when the handoff happened, I don't think we did a great job of, due diligence as far as what work in progress looked like. That being said, it was our first acquisition. The most important thing was to get started.
And how would you go about doing it today?
Sure. So I think detailed reviews of each of the ongoing projects would be the appropriate way to go, or negotiate the receivables for those projects so they all kind of hit at the same time. So not splitting up individual projects for like separate entity billing, if that makes sense. That's where we ended up getting in trouble in the first one.
So as you come in, there's a certain work in progress that
Mhm.
is maybe the second half or the third part of a big project.
Yep.
And so you go one by one on these projects, and let's say on average, how many projects do they usually have go ongoing like that?
So I think you can typically have the size of company that we were going after, maybe 2 to 3 of those
Okay,
big
so it's not a lot.
projects simultaneously.
It's not a lot. Yeah. So that portion that's left, work in progress, and then you have receivables that are
Mhm.
coming from the first part. So how would you negotiate that?
So I think we'd have to look at the project in its entirety. What
Yeah.
we just looked at was, what's left to bill on the project, and we just assumed it was linear. Like,
Got
hey, our profit is going to be, it's going to net 30%, and then after OpEx, it'll be 10%. That's what we said.
Oh, now I understand. So the first part of the project is the most profitable. The second part, okay, got it. It's not
Finishing is
profitable.
just, it's
Got
there.
it.
So
Got it. Makes sense. So, okay, that makes sense. So you don't assume. So how much did you guys do the second year?
second year, I want to say we did right around 400,000 in EBITDA. And then after we combined the two entities, the following year we were at 800,000 in EBITDA.
Got it. Okay. And then so that kind of give you some, so 18 the first transaction, and 19 you're doing okay. Third year, no, the third year is when you bought the second company.
Yep.
Okay, so how did you find that one, and what was the deal structure there?
So that one we found through a broker. So in the, from 2017 on, we've been trying to build relationships with brokers, with bankers, sub debt players, things like that, so that if they have something interesting come up, they'd let us know. The deal structure for this was from a broker. So this is a guy who had been working in the business for 30 plus years. He was 65. I'm in Minnesota, so he was looking to travel south to Florida for retirement. And he just kind of wanted to be out. So he had financials at, I want to say it was 300,000 in EBITDA, or just a hair under. And we paid 2x. And he had about $300,000 worth of FF&E. So they came with the business as well.
Nice.
So really good deal structure. We ended up buying a building that he built as well in 2021. So it was kind of a multiple transactions with the same person.
And that one had some debt in it. Did you go SBA, or did you get some financing for that one?
We did. So we went traditional. So all of our financing with our banking partner has been traditional. We haven't done any SBA debt yet. I think it's more about the compelling argument to pay all of those fees as well as sign your life over to the SBA, which it's got its pluses and minuses. I mean, they have some, oftentimes they've got attractive rates, longer AMs. They could do interesting things when real estate is involved. So they could stretch you out to 10 to 15 year amortization period. So net cash outflow in the business is lower, but I just wasn't able to get over some of the things that we had to pledge.
And you don't have any personal guarantee on those two?
So we do have some personal guarantees, but I think with respect to real estate, because I've got some rental property that is in a separate LLC, they didn't require us to pledge that, and that was the.
Got it. Cross collateralized. Okay. And now you have these two. How did you unlock the value of like having merging these two together? What are some of the things that you did that unlocked that value?
Shared back office. So when we first took over, when it was the first acquisition, the books weren't necessarily super clean. We didn't have the right admin staff to, from a go forward basis to keep those books clean. And then just general support for people answering the phones, things like that was lighter. And neither myself nor my business partner wanted to take on that activity. So in the second acquisition, we ended up getting not only the incoming projects, we also got the back end infrastructure.
Nice. Okay. And that seller left. He didn't stay on board.
Yeah, he stayed on for a couple of months to help with transition, but he's enjoying Florida.
And any issues culturally between the groups?
I mean, initially, yes. I think, when we were first taking over, it was like, yeah, you're all electricians, you should get along. But not necessarily the case. I think that we were able to kind of bring everybody together on multiple outings outside of the work environment so that people got to know each other a little bit better. Because this had been a business that had been around for, like I said, 30 years. They had long-term employees. And there was a sense of, I'll say sense of hurt when the old owner sold, because they didn't know, they didn't have any of that information, and they always thought that he'd be around. So when new people came in, new electricians were doing things a little bit differently, they were upset about it. I think we were able to blend the two. Granted, we did have some turnover from some of those long-term employees, but that's kind of, I think, par for the course.
Yeah. And what was you said the earnings on that first one, the second one, how much was the SDE on that second one?
I think it was just a hair under 300. It was like 275.
And then at the end, having done the due diligence, have you done different due diligence differently than they did the first time?
Yeah.
Okay. And then he ended up with that number at the end.
Yeah. So we ended up with combined 800,000 of EBITDA.
Got it.
So there was definitely some value unlocked. We were able to share costs. So you had some cost savings as well.
Nice. And then so how much was the total gross revenue in that company that year?
So the combined gross revenue, I think we were at 4 million.
And how much is it now?
Now it's stagnant for 4 million.
Yeah. Wow.
Yeah.
Okay. Why is that?
We've not been investing into that business as heavily. We've been investing more into the underground construction business. The margins are bigger. So we want the electrical contracting business to stay around. And if we can grow moderately, great. We've hired a couple of good estimator project managers. Yeah. But the key is to maintain that. It handles all of our overhead. It handles kind of those base expenses for back office support. But we are seeing really good margins on our underground construction and splicing business. So that's where we want to invest because it is a very capital intensive business.
Which one?
Sorry, the underground construction company. So we're just taking every dollar comes in, instead of reinvesting into electrical, we're reinvesting into underground construction.
Joey, you have a question? You're on mute.
These businesses full time.
Hold on, you're on mute. Say it again.
I think it's because he's driving. You can't hear him.
Is he driving?
Yeah, it's in his car.
No, I think he's just,
That's perfectly.
oh, he is driving. Yeah.
Can you hear me? No.
Yes.
Yeah, you probably turn off the video probably.
All right. Yeah. Maybe it's my headset's here.
There you go. Go ahead.
Can you hear me?
Yes.
Okay, perfect. Are you still in the software, or did you have a business now, or do you have people that are putting things into place for you?
Say that first part again.
Are you still working in the software company?
Oh no,
Sure.
I left my software gig in I'll say it was May of 2021. So I jumped in full time to do the acquisition side.
2 years into it. 2 years after
Yeah.
your first acquisition. Okay.
So you're spending your time on these, like working in or on these businesses mostly.
Yeah. So I spend my time mostly trying to coach the leaders of the underground construction and the fiber splicing business, and trying to put out the fires of the manufacturing company. But mostly I'm trying to just get the next level of leadership on kind of the same page, to think not necessarily about things at a job level, but hey, how's the company performing? So that way, when we do go to sell the construction companies as a bundle, we're able to say, hey, this doesn't need any outside influence. This is now ready to hum, and hopefully get an extra couple of turns because of that.
Makes sense. And then on the traditional financing, can you share some of those terms you got?
Yeah, so it's a different rate environment, but we work with a couple of different regional banks. So Old National Bank and American National Bank are our key partners. Today, we're looking at a couple of other ones, but basically 5-year AMs, and typically around 75% loan to value.
And the rate?
Yeah.
How much was the rate back then?
The rate back then was 3.25, and then now I've got one that's, I think, at 4.25 is our manufacturing company.
Right now?
Yep.
Oh, nice. When did you get that 4.25?
4.25 was April of 22.
Okay. Yeah, that's pretty accurate. Okay. So now let's talk about this. So the first two businesses, the electrical businesses, are okay. They're good. They're stable. They pay the bills. They pay the overhead. We're good there. We're not pushing too much. Now your focus is on the fiber optics and the in the ground construction, because you see the EBITDA margin is much higher there. There's much more bigger potential. There's much more money coming in from the infrastructure bill and all the investment that the government is making into infrastructure. So that's the potential is just unlimited the next few years.
Yes.
So tell us about how do you find them, why the sellers sold, and all the background story behind finding them and getting them, and then the transaction.
I mean, this was one that was by accident. We basically found them on Biz Buy Sell. And we thought, well, hey, they're not too far from our current office. I bet we can move them in and they should be fine. Their EBITDA numbers look great. What could go wrong? So, kind of stumbled into the deal to purchase this.
And they're both companies were one package, one owner.
Yes. Yep.
Got it. So
they were owned by the same.
And they were on Biz Buy Sell as a package, or are they separate listings?
No, they were there as a package.
One package. Okay.
Yeah. And the owner had a heart attack. I want to say it was 6 months or a year before, and he was struggling to kind of continue on. So it was health related why he wanted to sell. His daughter and his wife also found that, I kind of chuckle about this, but they said at the time they've really mastered day trading. so they could just make money really easily.
Nice.
To which I don't think that's the case anymore.
Yeah. Was this so? This is mid 2020 or late 2020?
Mid 2020. So everybody's
smack
afraid.
of COVID.
Yeah. So we closed May 15th of 2020. Everybody's afraid that the world is ending. Great thing is outdoor construction continued. So we had no shutdowns. We had no real issues other than our customers were a little bit afraid about, hey, are we going to get the funding? Are we going to get what we need? And they ended up saying, well, if everybody's working from home, we have a lot more customers that we need to service. So we need to invest and step on the gas.
Wow. Okay. So they had listed pre 2020 or during 2020 when they listed?
I want to say they listed in December of 19.
Got it.
We had an LOI in front of them in February, started due diligence, and then went to close in May.
Got it. And how much was the business listed for? How much and what was the EBITDA and what was the purchase price?
It was listed for 2.6, and EBITDA listed was, I want to say it was like 400.
Okay.
We ended up buying the company for 2.1. 400 was EBITDA, and then came with, I want to say like $1.5 million in capital equipment.
And the EBITDA turned out to be real?
Yeah.
Okay. So you did the due diligence. Good.
Yeah, year one. So the benefit of this one is it is very linear. There's not the same kind of project issues that you have with electrical construction. It's basically the way those drills, horizontally bore, you get paid per foot. So how much work the machine does and the crews do is what you get paid for. So it's not on a per project basis.
How about the splitting one?
The fiber splitting, same kind of thing. They call it burning fiber optic cable, or the number of burns. So on mainline fiber, you'll have these really thick fiber optic cables that have 288 strands or 432 strands that they have to go in and burn. And we basically bill on a per burn basis.
Got it. So the margin is the same. It's markup over labor, and then you're good.
Yeah.
Got it.
So it's
Okay.
that is an incredible business that I'd love to spend a lot more time growing.
Nice. And so what are the things, the characteristics that you love about this business?
So right now it looks like we have a really significant uptick in demand for the service, and the supply is the constraint. So we're able to uptick our pricing a significant amount and still maintain our customers. So year one after the acquisition, we're still trying to figure out the business. Our EBITDA was $67,000, so not very high. We scrapped some equipment, things like that. Year two, we were at $800,000 in EBITDA. Last year we did 1.1. This year we'll do 1.5 in EBITDA. So it's growing pretty well.
So you financed this business, right?
What's that?
Was it financed also?
Yes.
You got debt on it, and having your financing set based on 400K in EBITDA, and then having a year with 60, was that an issue with the lender?
So the lender, we've done a really good job building the relationship with our banker. He's been, really easy to work with. We do have cash flow covenants. And I think as long as we're, and knock on wood, we're open about, hey, here's what we're doing, here's kind of the challenges we're running into, etc. We're all right. I don't think they're going to call the loan in. But year one was a challenge.
Okay. So it seems like it's a trend. It's always like year one is a challenge. What do you think the issue usually is in that year one?
Poor due diligence.
Okay. No, that's great. That's what we like. It's hard. It's hard to do diligence to every business, the
Yeah.
same way. And So what was the thing this time?
So I would say, when we went to go look at the equipment, we should have had a third party appraise the equipment, in our excitement. And, this is the fault of both myself and my business partner. We're wide-eyed optimist and, not looking at, hey, there could be potential downsides, etc. It's like, hey, look at this. This is so fantastic. We're going to make this thing phenomenal. Having an independent party value the equipment, because a lot of it was old and garbage, or turning on the equipment to make sure it ran. So those are the things that we joke about now, but
Yeah.
at the time it was foolish not to do that.
Got it. So just have someone inspect the equipment and then find out what's worth it and what's broken
Right.
and all that. And then, so how much money did you have to spend that year to have enough equipment to service the projects you had?
So I'll say we got by with the equipment we had. A
Okay.
lot of it was vehicles. So, the vehicles were in really rough shape.
Okay.
So over the last several years, we've purchased, 10 or 15 new vehicles for that business. And so that's been the biggest cash outflow, just updating vehicles. And then we've purchased some other drills to expand. But each one of those drills is about $300,000.
Wow.
Plus a semi, plus, support trucks, things like that. So it is really a return on assets game.
And the transaction, when you buy, was it an asset sale or an equity? You bought the
It was an
company?
asset sale.
An asset sale. Was that an issue for the new entity that didn't have credit because you had to go out and buy more equipment? Was that an issue?
No, that ended up not being a problem. Yeah.
Oh, good. Okay. I've heard that being an issue because you're talking about a lot, 12, 13 vehicles and drills and
They weren't all at once. So we ended up buying, 2-3 vehicles at a time.
Okay.
And the benefit of this business too, comparative to electrical contracting, is that payment terms are very favorable. So in electrical construction, it is do the work, there's monthly billing cycles, and then from there you have to wait till the general contractor gets paid. And then once they get paid, they'll disseminate funds to every other specialized contracting group that has been working for them. So you're typically in that net 75 to net 90 from when you actually submit the bill. We've now negotiated terms with our ISP customers that they'll pay us in net 30 or oftentimes less.
Nice. For the drilling business.
Correct, for the drilling business.
Got it. Okay. And I know if you guys have any questions, please, go ahead and ask it, because I can talk to them all day.
I got a question here. How have you handled the master electrician license across the businesses? Now you have some scale, so is it multiple? Do you rent them? Do you have a guarantee with previous owner? How'd you tackle that?
So one of our team members ended up testing and getting his master's, and so now we run everything through his license for the electrical construction business, and we've promoted him to be a GM. So we're training him to take over. He's really happy with taking on more of the leadership role. And the other benefit is our headquarters is in his hometown, and it's in Hastings, Minnesota. So not a huge populous area. So we're not super worried about him leaving to go to another place, because he's invested in the name of the business, really close relationship with the old owner, and he wants to make sure this thing is successful. So it's been really good to transition to him as our.
Okay, but you still have one.
Correct.
So what gives me heartburn about that is he might have all the best intentions, but if he got hit by a bus, then
Yep.
What's plan B?
Yeah, so you're right. What was it extreme ownership? They talk about, well, 1 is 0 and 2 is 1.
Yep.
There are a couple of different avenues. You can rent a license. We're actually looking at hiring an engineer for the business as well, and an engineer can actually take the master's test too. So you don't necessarily need to have all of the journeyman's experience, etc., to get a master electrical license. As long as they're an electrical engineer, I think we'll be all right as well as a backup. But right now, you're right. There is a lot of risk.
Okay. And are the electrical companies residential or commercial or both?
Both. We stay away from industrial.
Sure. Yeah,
Why?
big projects.
What's that?
Why? Why do you stay away from industrial?
We don't have the right skill set or talent on board yet from the companies that we acquired.
Got it.
And Jen, are you buying close by to you, or where geographically are you buying? How far away from where you're at?
Yeah, so we ended up buying. So our first acquisition was in a north east suburb of Minneapolis. The second one was in a southeast suburb of Minneapolis. They were about 45 minutes drive time away from each other, and then we ended up just consolidating in our southeast kind of location. The benefit is we don't require our electricians to come in every day to the shop. So they have their vans. They, if they need to come in, get parts or what have you, great. Or they can have our vendors deliver directly to them on site.
Okay, got it. And how far away are you from that? Sorry if I missed that.
I'm about 45 minutes.
Okay, so this is pretty close to where you're at in case you got to go in and say hi.
Our manufacturing company is about an hour and a half away from where I'm at. So it's less
So
fun.
he has, I think his partner is the one that runs the electrical business. He's focused on the fiber optics now.
Correct.
Got it. Yeah. And your partner lives nearby?
Yeah, we're basically next door neighbors.
Nice. That's cool.
So we carpool a good amount.
What was your role in those 2 years that you still were working as a software engineer?
It was more just review of financials.
And your partner was doing most of the
Yep.
day-to-day stuff.
So, hey, Chandra, just to confirm, your experience as a software engineer didn't really help you with acquiring or managing or running any of these companies, right?
Correct.
Okay, got it.
Yeah, no, I was a consultant, but so I'm definitely not smart enough to be an engineer.
But he was more on the consulting side. Yeah. So I understood a little bit of process. So he had some process design and improvement, knowledge. So that helps.
It makes consulting is a lot easier because you don't have to actually implement the solution that you come up with. And that's what I found with our acquisitions. It's a lot easier to talk about the solution than get
But also the solution that you implement the first time doesn't, it may work the first 6 months to a year, but the world changes.
exactly.
And the people change, and it's a whole different world the next year. So,
Yep.
that's cool. So I want to, if you guys have questions, please go ahead and ask them. But I want to go to his next deal, which is kind of a little bit more painful for him. But he's going to tell us about. So this is the fifth one, right? So you have 5 total, right?
Yep.
Okay, got it. So tell us about the last one. How did you find it? What was the purchase price? All that stuff.
It was it's trailer manufacturing. So equipment trailers. It seemed like a pretty good offshoot because in construction, the lead time for a equipment trailer was pretty high, and the demand is really high because construction isn't slowing down. And so we met this guy. I think they were also posted online through a forum. We met them through a broker, and purchase price was 1.85. Came with real estate. So we were like, we're hedging our bets a little bit. Advertised cash flow was, I want to say it was 450 or just above 450. And unfortunately that was not accurate. And so this is one that's a little bit more painful because we also did a higher level view of due diligence than we normally do. The guy said he was suffering from, he had cancer. He had only a little bit of time left. And we're like, okay, well, let's just make this deal go by quickly. Very, very foolish on our part. But so after we kind of get into the deal, so like I said, 1.85 was the total purchase price. About $1 million was real estate. So we did 2x what, a little bit over 2x or under 2x what the cash flow in the business was. 250K of seller financing. We financed the remaining amount. I think we brought $200,000 to the table, so we financed the remaining 1.4. Get into it, start looking at all the manufacturing process. First did an overhaul of the shop so that it made sense. They had very disparate processes. So when you're manufacturing a trailer, the shop kind of setup wasn't really optimal. They had a giant powder baking oven in the middle of the floor. They had paint booth in the middle of the floor. So we kind of reorged a lot of those things. But as we get into it, as we're looking at things like costing, none of this stuff is making money. And so we went back and reviewed some of the financials and talked to customers. And what he had done was he had shown deposits for trailers. So, hey, I want to order, 50 of these trailers. Here's a deposit for $100,000 so that I'm serious. He would count that as revenue rather than a deposit on the balance sheet. And so when we were looking at these numbers, we're like, oh, well, great. Everything has a 30% clip. He's doing great. But in fact, none of the costing was accurate because it was all losing money. It was just deposits. So after we purchased the building, he went back. He refunded deposits to all those customers, so the revenue wasn't real. So fake the revenue is not.
And how much is the real revenue?
Real revenue right now, I think we're at like a $600,000 clip per
As
year.
opposed to what was it before? 2.5?
Yeah.
Okay.
And he faked cancer too?
Yeah.
Yes.
Yeah.
Man. And so you said you did a higher level due diligence, meaning lighter, you mean lighter
Yeah.
level?
Yeah. Because we were like, all right, we'll look at these numbers. We looked at the bank statements. We looked at his P&L. All right, the revenue's there. It's kind of what we.
Okay. Wow. Okay. And the equipment, there wasn't much equipment.
There wasn't a ton. I mean, the oven, the powder coating oven worked. It still works. That's fine.
Yeah.
Air compressors. We ended up purchasing another one that was like a $10,000 expense. Nothing crazy.
Got it.
But none of the actual numbers for due diligence were real, and that's the hiccup.
Sandra, Paul here. Sorry, guys. I had a migraine today. I'm in bed, like not feeling good, but I wanted to be on the call. Yeah, I get migraines out of nowhere. Like puke, it's awful. But
I'm sorry, man.
nah, no problem. Yeah, I was wondering, and under those circumstances with that seller, are you able to take him to court? Because sometimes they force them to give the money back in terms of a business deal or whatnot. So have you thought about litigation on that particular deal? Because it's just like fraud almost in a way.
Yeah, I 100% think it's fraud. We have kind of delivered all this stuff to our attorney, and we're holding back paying the seller note. So that's at least 250 grand. Well, now it's 200 grand that we're not paying on. But yeah, I don't know if we're going to be able to get much out of them.
Okay.
That's what I was going to ask too. Is like, what kind of reps and warranties did you have in place to protect something like that?
Yeah, not enough.
Yeah.
Not enough.
Is that what our lawyer said?
Yeah.
So what did he say? What would have been a better term in there too?
Yeah. So all of our previous acquisitions, we had gone through a third-party attorney who basically put together the buy-sell docs, and they kind of have all the standard boilerplate information around warranties, around whatever truthful due diligence, etc. We did not think to add this. We're like, this guy's dying. He's not going to rip us off if he's dying. And so it was definitely a lesson in being too much of a bleeding heart.
Yeah. So you said add this. What is this?
What's
You said you didn't think about adding this. What was this?
adding like really detailed language around warranties, around I'm trying to remember the specific clauses, what they're
Okay.
called, but it's around being truthful during due diligence
Got
is kind of what it ends up being. I think where our case for holding back seller financing is around one, the information of financials, but also he continued to use the name that we bought and make trailers 50 miles away. So
Oh, wow.
it's outside of the non-compete. So we're trying to get him on that. But
This guy's a terrible person.
yeah, right?
Wow. Not only he's faking his debt, but he's also competing a few miles down. Wow, that's crazy.
Yeah,
And
yeah.
what kind
So-
of guarantees do you have? Personal guarantees or anything tied to this?
On this one, yeah, we do have personal guarantees with the bank.
But the majority of the debt is
Oh, real estate.
real estate.
Yeah, so the real estate I think is the saving grace. I think the real estate is probably appreciated a little bit in value. So my hope is one, we capture a lot of the loss from last year in an R&D tax credit, and then we go to either we sell this as an asset sale and include the real estate and have this be, hey, really open. We want to really focus on the construction businesses. That's the route that I think, this morning I was reflecting on it, thinking about some of the headaches and how much time we have to spend on it. And I think it is a better way to go to focus on the businesses that are doing well and try to cut our losses instead of having the, shiny object syndrome.
Yeah.
Hey, construction is doing well for us. Real estate is doing well for us. Let's focus on those two rather than try to get into every different type of company out there.
Yeah. Well, I think, every transaction you're learning a little bit more about what your real buy box is, and then what do you like about that business. So when I know from our conversations before, you like that splitting business even more than you like the drilling business.
Yes.
Because you have less capex, and you have a little bit more, but then you have the challenge of recruiting. So how do you think through that?
So I think the skill set for fiber splicing and our electricians are very similar. And so what we've done is we've taken some of our apprentices who have done well, have shown promise, and we've actually teamed them up with our lead splicer. Said, hey, give this a shot, see if you like it. And that's going to be our route to try to make talent versus trying to hire outside.
So you're developing in-house, and are you promoting these the experienced guys to become managers or leaders?
Yeah, so we're promoting them and also increasing comp.
Got it. And what's the vision, to build these teams around these experienced guys?
Yes. So I think for the splicing business, I mean, our revenue is really low, but our EBITDA is high because of how much margin there is in that splicing world.
Yeah.
So I could probably bring it up. I think right now we're at something like $300,000 of revenue for the year. Granted, because it's Minnesota, a lot of the splicing activity happens after construction, and so we've only had a couple of months of real activity, but we're already at $150,000 of EBITDA. So
Nice.
it's pretty strong by comparison to any of the other companies we have.
And do you feel like you need the construction, the drilling, the underground construction business in order to grow the other one? Do they need each other? Or
They do, not necessarily under our ownership, but because we've gone out and made relationships with other underground construction companies, splicing can do well on its own. But our goal is to try and grow the construction group as a bundle and then hopefully sell the entire thing down the line.
Got it. And how are you planning on growing that business? Are you hiring more outside sales guys, or you're hiring someone who just sits there and then bid on government contracts all day, or outsourcing that part, or what's the plan?
Yeah, we do need to hire, I think, a growth person across the 3 divisions. And that's just somebody who will, more like a business development person who will kick down the doors and then introduce them to our project managers and our estimators who will get numbers in front of them. The only issue is, and this is something that we've kind of learned recently, that those estimators and PMs, they're not great at, like I said, knocking on doors and making those intro relationships, at least the ones that we have on our team.
Yes. And you probably want more than one guy, the
Right.
growth guys, because those growth guys are salespeople and they want
competitive.
to make more money. So,
Yep.
Once they see, you show growth by 50%, they're going to go sell it to the next guy to get the gig. So, okay. And how about the government bidding process? Because that's just like one guy with a laptop sitting just bidding on stuff all day.
Yeah. So government work. So we are a state approved contractor. So that's good. That was a process in itself. And we do have in both of the businesses guys who are dedicated to handle those bids. Now, it's not enough for a full-time job because we don't want to have guys traveling as of yet. That really puts a lot of pressure on margin. And because there's a lot of work very close by, that's kind of what we want to capture first. So it's, hey, they're going to be either out in the field or they're bidding on things as well.
Got it. So you're saying there's not enough work for them to go just within, there's enough work for them to find within the geography, but not enough for them to stay busy?
Yeah, so it's not a full-time job to just bid all day. So I think if they spend maybe 5 hours of work a week bidding, that's probably the most that they're going to want to do. Otherwise, you start to look at your region creep and start to get in areas where you're 2, 3, 4 hours outside of kind of where people live. And then you have to look at things like hotels, per diem, all things that just kind of crush the margin of the service.
Yeah. And it's all your business, government business now, or there's some B2B?
No, it's a decent mix. So we have some state work. We have work directly with internet service providers on the fiber side, and then a lot of our work on the electrical side is with general contractors outside of the government space.
Got it. Cool. Well, I appreciate it. Any final questions, guys? No? Go ahead, John.
Yeah, I was gonna jump in. Hey, Chandra, thanks for sharing your story. I've spent the past decade in Silicon Valley working in tech companies as well. I'm planning to make a transition out in the next year. I was curious about the intellectual stimulation and the peer group and the people that you're used to working with versus being the work and how you handle that transition. It's one thing to see a P&L. It's another to think about the enlightenment that you get from working around people that have bigger ideas or doing things that are more interesting, or that some people may find more interesting. I don't want to project it on you. I'm curious.
It was very difficult, and you're absolutely right. I think when we first started, I got into the bad habit of trying to be in the business and trying to learn all the details of what the businesses were, what the activities for each individual were doing. And I kind of went down this rabbit hole. I was like, what did I do? I made the biggest mistake leaving, the SaaS company and now doing this stuff. But, after we hired a couple of key managers and now it's focused on their growth, I get a lot of gratification out. I really like coaching them and just kind of having them up level their leadership game. And then GoBundance has helped a ton. I would say that's been a really big relief for me to talk to other peers who are doing cool things, and then see what we can do, like brainstorming wise, to try to up level each other. So,
yeah, entrepreneurship is a lonely single player game. It's tough. Even when you have a partner, it's tough. And are you like so what is your are you planning on a next acquisition already, or are you taking a pause until you solve this manufacturer problem and then you go next?
So we met with another underground construction company. We met them at it was an insurance event, for shooting clay pigeons or sporting clays or something.
Nice.
And so I went to this event, and I'm terrible at this sport, but I was like, hey, I'll meet some people. It'll be great. So the worst one there, but chatted with this guy, and he's, we were telling our story about how we're acquiring these companies, and he was saying, well, my father is retired. I'm second generation leading this underground company, and we need to figure out what to do next. And so we've had some initial conversations, just had our mutual NDA signed on Friday. And so he's going to send over financials. He has got a much larger operation. He's doing 18 million in revenue. Compared to us, our combined entities are right around 12. So a decent uptick. And I'm trying to remember what his EBITDA numbers are, but I know they're compressed because they travel quite a bit. So he's at a $2 million EBITDA number. So
Nice.
It'll be interesting to try and get a little bit more data from him and see where the conversation takes us.
So the goal is to merge the entities and then grow together.
Yeah.
Got it. Nice. I love it. Yeah, that's awesome. I think that's the way to go. I think the challenges that you mentioned earlier around sellers looking at exiting because of the labor component and the cultural change from the baby boomer to the Xer to the millennials. I was in the pool yesterday or the day before. We were talking to somebody, and then he was like a lieutenant at a penitentiary center in Austin, and I was asking him about his like challenges, and he was like the main guy over 1,200 like inmates, and he said the number one problem is finding good people to work because all these millennials or there's Gen Zers have different work ethic habits and different style, and then that's his number one challenge. So I think that element, it's going to make it where a lot of people want to exit and get tired, and then if you can develop the skill to manage that group, because that's what it is. It is what it is. If you learn how to manage that new species, you have a big advantage in terms of acquisition.
I think we've had a lot of success in expressing the vision of taking care of our team members. So it's, hey, you help us grow. We're all in it together. And we're going to do things like, hey, we want to introduce a $0 out-of-pocket healthcare plan. So every employee and their families get covered. So something similar to what I was able to experience in a Silicon Valley company now is in a blue-collar space where it's very different than what I think exists today. The other thing is in construction, this is a place that is, I still think the industry is in the 70s where guys are getting yelled at for doing stuff wrong. It's like, if I ever got yelled at in when I was working for a California company, that is kind of unheard of. Yeah. So we've kind of changed that culture for the companies that we've acquired and focused more on, hey, here's how we have to help people develop. Here's how we up-level a leadership game, all those kinds of things. And it's been hard to turn the ship, but it seems to be working. Now it's just being able to get out of the manufacturing game and focus just on this construction side.
Yeah, and the new acquisition years are like dog years. It's 7 in 1.
Yeah.
So it feels tough the first couple of years.
I've aged terribly.
And then I think that year 3, that's where you start kind of like feeling comfortable with the business and feeling that you see the light. You can tell where the vision is going. Well, I really appreciate you for sharing your story and your experience. And hopefully we can work together and help you on the next multiple acquisitions. So
thank you for inviting me to the group. I'm looking forward to it.
I appreciate it.
I can share all of my mistakes. So that
it was great. No, it was awesome. There's no way around it. That's how we all learn. Yeah. I appreciate it, man. Thank you guys.
Thanks.
Thanks,
Bye.
Chandra.
Take care.